Every time the world breaks, someone gets richer. It's not by accident, not by luck, but by design. When markets crash, when currencies fall, when nations panic, we're told everyone loses. We're told it's chaos. We're told no one could have seen it coming. But here's the mystery no one explains. If crises destroy value, why do the same institutions emerge bigger, stronger, and wealthier every single time? Why does pain feel universal, while profit is always concentrated? Why do the biggest fortunes seem to be born not in booms, but in breakdowns? This is not a story about corruption in the shadows. It's about a hidden mechanism in plain sight, a system that quietly turns crises into billion-dollar opportunities. While convincing the rest of the world it's simply recovery. Once you understand how it works, every crash, every bailout, every emergency starts to look very different. To understand this mechanism, we need to strip away the comforting idea that crises are purely accidental. History shows us that financial systems don't just collapse randomly. They are built with specific incentives, and those incentives shape who survives, who fails, and who profits. Long before modern stock exchanges and central banks, power was already learning how to exploit instability. Ancient empires discovered that shortages, wars, and debt weren't just threats, they were tools. When people were desperate, they accepted harsher terms. Resources were scarce. Those who controlled credit gained leverage. Crisis didn't eliminate power, it concentrated it. In early societies, wealth was mostly physical. Land, crops, livestock. When disasters struck, everyone suffered together. But as economies grew more complex, something changed. Money became abstract. Debt became transferable. And with that shift, crises stopped being equalizers. They became filters. Those with access to liquidity survived downturns. Those without it were forced to sell assets cheaply, surrender control, or disappear entirely. This was the first quiet step toward a system where collapse itself became profitable. Fast forward to the rise of modern banking. As trade expanded across continents, merchants needed credit to move goods before profits were realized. Banks emerged to meet that need. At first, they were simple intermediaries, but over time they gained a powerful advantage: information. They could see who was overextended, who was desperate, and who would fail first when conditions tightened. In moments of stability, this advantage mattered little. In moments of crisis, it mattered everything. The origins of crisis profiteering lie in this asymmetry. When a downturn begins, fear spreads faster than facts. Asset prices fall not because their long-term value disappears, but because short-term liquidity vanishes. Those who need cash immediately are forced to sell. Those who have cash can wait. This gap between forced sellers and patient buyers is where opportunity is born. And financial institutions are structurally positioned on the patient side. As central banking developed, this mechanism became more formalized. Central banks were created to stabilize systems, prevent panics, and act as lenders of last resort. On paper, their role was protective. In practice, they introduced a new dynamic. By deciding when liquidity would be provided to whom and under what conditions, they gained immense influence over crisis outcomes. Not all institutions were treated equally. Some were deemed systemically important. Others were allowed to fail. That distinction would become one of the most powerful wealth transfer tools in modern history. The rise of financial markets in the 20th century amplified this effect. Stocks, bonds, derivatives, and complex instruments tied global economies together. Growth accelerated, but so did fragility. When confidence was high, leverage expanded. When confidence broke, leverage imploded. And every implosion followed a familiar pattern. First came denial, then panic, then intervention. Finally, consolidation. The breaking point usually arrived when debt could no longer be serviced under existing conditions. Borrowers defaulted. Asset prices collapsed. Banks faced insolvency. At this stage, governments stepped in not to save everyone, but to prevent total systemic failure. Emergency measures were introduced. Interest rates were slashed. Liquidity was injected. Bailouts were justified as necessary to protect the public. But the distribution of that protection was never neutral. Large institutions received immediate support. Provide them with liquidity, the logic went, and stability would return. Smaller firms, households, and local businesses were told to endure the pain. Assets flooded the market at distressed prices. Entire sectors were restructured under crisis conditions. And quietly, ownership changed hands. This is the hidden mechanism at work. Crises compress time. They force decisions that would normally take years to unfold. Regulations are suspended. Rules are rewritten. Public resistance is weakened by fear. What would be politically impossible in normal times becomes inevitable in emergencies. And those with capital, access, and influence are positioned to take advantage of the speed. Look at the fallout from major financial crises. After the Great Depression, new financial giants emerged. After the oil shocks of the 1970s, energy and banking power consolidated. After the 2008 financial crisis, the largest banks became larger, while millions lost homes and savings. The narrative focused on recovery, but the structure of the economy quietly shifted upward. More assets under fewer owners. More influence concentrated in fewer hands. The failed fixes always follow the same script. New regulations are announced. Oversight is promised. Safeguards are put in place. But the core incentive structure remains untouched. Profits are privatized. Losses are socialized. Risk is rewarded during booms and protected during busts. This creates moral hazard on a massive scale. Institutions learn that taking bigger risks increases upside without increasing long-term downside. Crises become not just survivable, but desirable. Modern parallels make this pattern impossible to ignore. During global emergencies, central bank balance sheets expand by trillions. Asset prices recover faster than wages. Stock markets reach new highs, while real economies struggle. Those who own financial assets benefit disproportionately from stimulus and liquidity injections. Those who rely on labor income face inflation, insecurity, and shrinking purchasing power. Shocking data reveals the repetition. After recent global crises, the wealth of billionaires surged while poverty increased. Market recoveries favored equities over employment. Housing prices soared beyond affordability as investors bought distressed properties in bulk. Each crisis acted as a lever, transferring value upward under the banner of stabilization. Technology has only accelerated the mechanism. Algorithms trade faster than humans can react. Capital moves across borders instantly. Information advantages widen. When panic hits, automated systems amplify volatility, pushing prices lower, faster. Those with pre-positioned capital step in at the bottom. Speed becomes a weapon. And yet the story told to the public remains unchanged. Crises are framed as unfortunate but necessary corrections. Bailouts are described as unavoidable. Inequality is treated as a side effect, not a feature. The mechanism stays hidden because it operates through legality, complexity, and urgency. No single villain is required. The system does the work. The most unsettling realization is that this mechanism doesn't require conspiracies. It functions through incentives. When rules reward certain behaviors, those behaviors dominate. When crises reward consolidation, consolidation accelerates. When fear weakens resistance, power expands quietly. Over time, this becomes normalized. Each crisis feels worse, but also more familiar. So what happens next? History suggests the pattern will repeat until confidence breaks, not just in markets, but in the system itself. When people begin to see crises not as shared hardship, but as engineered leverage, trust erodes. And without trust, even the most sophisticated financial structures struggle to survive. Here are 3 takeaways to hold on to. First, crises are not just economic events. They are redistribution events. Value doesn't disappear, it moves. Second, access to liquidity during emergencies determines winners and losers more than productivity or merit. Third, the greatest risk is not collapse, but repetition. A system that depends on crises to function eventually runs out of credibility. So here's the warning. If emergencies keep producing the same outcomes, they stop being accidents. And when societies realize that breakdowns consistently enrich the same few, pressure builds in unpredictable ways. The question isn't whether the mechanism exists, it's how long it can remain hidden. If you want to understand how money, power, and crises are truly connected, Keep questioning official narratives, follow the incentives, and look closely at who benefits when everything else is falling apart. That's where the real story always is.